My name is Matt Penfold, working for Fiduciary Wealth Management. We're based in Gibraltar, but also regulated in the UK, and our advisors are regulated to give advice in Europe as well. We start on planning the UK return. You're originally from the UK, you moved to Spain or Portugal, Gibraltar, maybe elsewhere, and you've decided to return to the UK for whatever reason. So one thing is that there's a few important things to take into account. Firstly, you need to consider when you exit the country that you're now living in. There may be requirements. It's very important to exit cleanly and officially. So notify the tax authorities in the country that you're living in that you are now leaving. Otherwise, they may be chasing you for tax bills further down the line. And also, in an ideal world, you might want to consider when you leave. Okay. So by that, we mean that the timing of the year, and in an ideal position, you would exit the country at the end of their tax year. So, for example, Portugal and Spain, the tax year is a calendar year. If you could then exit in December, and then you've got a clean tax year that you're paying tax in that year, you can do your annual tax return, then no more. Of course, in that situation, we do have the issue that the UK runs a different tax year to those countries, April to April compared to the calendar year. So you have to bear that in mind. Some countries operate a split tax year, which the UK does, but only in particular circumstances. So if you return to the UK to start work, you return to the UK because your spouse is starting work, or you return to the UK and that is now your main home. So if you sold your main home in where you're living now, you return to the UK, then you can have a split tax year when you arrive. Otherwise, you need to be careful that, okay, how many days have I spent in this country? How many am I liable for tax in this country or the UK? And that should be assessed by a professional before you do that. And then we have the UK statutory residency test. So the UK statutory residency test effectively measures how many days it will take for you to become UK tax resident. So say if it's not just a clean break, you're selling everything, you're moving back. The UK statutory test measures when you exit the UK and when you arrive. So for example, when you exit the UK, depending on the number of ties you have with the UK, that may deem that you can only visit the UK for 45 or 90 days. Any more than that, you would re-trigger UK tax residency. The same on the return. They look at the number of ties you have with the UK, and that will define how many days. So you may be considering, we might be returning to the UK in a couple of years, but we want to spend a few more days there now as we prepare that. You need to be careful, assess and have a professional assess a UK statutory residency test, just so you don't trigger UK tax residency before you are planning to do so. Because a lot of people think, well, I can only have tax residency in one country. That's not true. You could trigger tax residency in two countries. A lot of people always think of the 183-day rules. And okay, if I spend less time than that in the UK, less than half a year, I'm not a UK tax resident. That's not necessarily the case. If you've got ties to the UK, may be that you spend less time than that and you trigger UK tax residency. Now, the second part, the UK domicile and your UK inheritance tax liabilities. So we've talked about tax residency. Now we talk about tax domicile. Again, in a lot of European countries, Spain and Portugal being good examples, your liability to inheritance tax or succession tax is based on your residence. So where do you live? Okay. So in some areas in Portugal, they don't have succession tax if you pass to your direct descendants. In Spain, it depends on the region that you live in, but that's based on where you live. And the UK inheritance tax is based on your domicile. So one thing people underestimate is when you leave the UK, you may still be liable to UK inheritance tax because you don't lose your UK domicile straight away. You need to be outside of the UK for at least 5 tax years. And there's other complications. You need to make sure that you've cut all your ties with the UK, effectively that you've exited for good. Now, you may be in a position where you have lost your UK domicile or you didn't have your UK domicile in the first place. So you think, great, I'm no longer UK domicile for the purpose of inheritance tax. That's 40% that my estate doesn't need to worry about. But if you're returning to the UK, you need to be careful that you are likely to re-trigger UK domicile. And that could happen immediately because effectively, if you moved out, you intended to live in Spain for the rest of your life, but you've returned. So HMRC will effectively said, okay, this individual was out of the UK for 10 years, but they returned. They never lost their UK domicile. They always intended to return. So the chances are if you're planning to or returning to the UK, you will be liable for UK inheritance tax. And that could be even before you return. So you need to plan against that. So you're returning to the UK, you have relatively large estate, you need to be concerned about UK inheritance tax. Now, one thing we say to a lot of people, and it's quite a common term now, is UK inheritance tax is often referred to now as a voluntary tax. And what they mean by that is there are ways you can plan to avoid UK inheritance tax, legitimate ways to avoid that. And at 40% of your estate, and that's your estate where you've already paid tax on the majority of those funds, it's a large amount. And the amount that the UK recoups from inheritance tax grows every year. I think the average now is around 260 grand. So it's a huge amount. And the UK relies on inheritance tax. I saw something, I think it was last night, and some people suggesting that countries, I think it was some Nordic countries, Norway and Sweden, they should scrap inheritance tax. That's not going to happen. There's just too much money that the UK government, and they target a certain demographic. Your super rich aren't paying inheritance tax because they have plans against that. So you need to look at the options to do so. Now, the first one is simply to take advantage of your gifting opportunities. So you can make smaller gifts each year, around 3K, and that money is immediately outside of your estate for UK inheritance tax. There's also allowances when you gift, if you give a wedding gift or a one-off gift to a child. As opposed to that, then you have the 7-year rule. So the 7-year rule is effectively you gift something to one of your children, family member, then that remains in your estate for UK inheritance tax for 7 years. If you survive 7 years or more, then it's not. And during those 7 years, the amount of that gift that's liable for inheritance tax reduces each year. So the longer you survive for, the less tax. But you do have to wait that 7 years until it's outside of your estate for inheritance tax. And also, you've got to make sure that it's a clean gift. What I've come across before is people saying, okay, my parents are going to give me their house. They're getting a bit older. They're worried about inheritance tax. They're going to transfer that in my name, and therefore it's not liable for inheritance tax. That's not true. If the parents are still living in that house, they haven't gifted that to you. The only way that really works is A, the house is gifted for you and then it becomes your house, you use it, or maybe they gift it to you and you rent it out and you receive rental income, as long as you retain that rental income. If you're gifting a property, then the person who's gifting it can have no more relationship to that property. The only situation where they can is they can continue to live in it, but they have to pay rent to the person they're gifted to. And that rent needs to be at market rate. They can't just say, okay, we're paying you £100 a month. That's our rent, when properties in that area go for £2,000 a month. Again, that's not a true gifter. Now, for those gifting and the 7-year rule, there is a danger that if something happens in that 7 year, then that amount is still liable for inheritance tax. So there are options. You could use something called a gift inter vivos policy. So that's an insurance policy designed for this purpose, and it covers the liability of the inheritance tax. So you gift £1 million, 40% on that, the inheritance tax liability is 400k. The policy can cover that 400k. So if you were to pass away in that first year, it pays out and that payment covers the inheritance tax liability. And then the policy reduces in value over the term. So as you go through that 7-year period and the inheritance tax liability reduces down, so does the cover in the insurance. So it purely kind of covers that particular amount. And then in year 7, the policy matures, no longer is required because there's no more tax liability. So a gift inter vivos policy is a very good way of being able to gift something to someone, but also you cover the inheritance tax liability in that 7-year period. Now, another option you could have is using something called a QNUPS, which is a qualifying non-UK pension scheme. Because it's a pensions are generally outside of your estate for UK inheritance tax. So we'll cover QNUPS a little bit later. And another option, and this is a tax, so this covers succession planning and taxes. You can use a UK bond, but that UK bond, you settle that in a discounted gift trust. So I'll cover the detail of that a little bit later as well. We talk about the taxation in the UK. So you've been living in Spain, Portugal, Gibraltar, maybe somewhere else, and you're used to the taxation there. You return to the UK, there's been many changes, many budgets since you went. You're used to different taxation. So you need to be kind of careful of, okay, what is the taxation and how can you protect against that? So very simple run through this. So your income tax is on bands that increase the more you earn. You have a personal allowance of 12,570, then you pay tax at 20%, 40, 45%. You have a capital gains allowance of 12,300 for the last tax year. and this cannot be carried forward. So if you didn't use it, it's gone. For this tax year, that is reduced down to 6,000, and from April 2024 onwards, it reduces down to 3,000. Now you can carry forward losses and offset this against future gains, but you can't carry forward your allowance. So capital gains allowance is reducing quite dramatically, over 50%. 50% again. Any gains above that at 18% or 28%. So you really need to make sure that you use the tools available to manage against capital gains. We'll cover that. You also have your dividend allowance. Again, this is now £1,000. It was £2,000 last year, now £1,000. That reduces down to £500 from April 2024. And finally, you have your savings interest allowance, which is called the personal savings allowance. If you're a basic taxpayer, you have an allowance of 1K, 500 for additional rate payers, 500 for higher rate taxpayers, 0 for additional rate taxpayers. So that's to cover interest that you are generating. So you do have allowances. And when we ran this webinar last year, we were saying how generous the allowances are. Now, the capital gains allowance has come down dramatically in the recent budget. So less generous now, and the need to plan is more important. So how can you do that? Now, the first one is to take advantage of your ISA allowance. So an ISA is a tax wrapper around either cash or stocks and shares ISA. Once you're a UK tax resident, you have £20,000 per year. And if you're married, that could be 20K for you, 20K for your wife. You can't carry over this allowance, so it's a kind of use it or lose it. So the ISA wrapper is wonderful. You know, it protects against capital gains, dividend tax, interest tax. Once it's within that shelter, if you're a UK tax resident, then that works great for you. So use that allowance. There's also a junior ISA for children under 18. Again, it's worthwhile using that allowance. It's very generous, and that can convert into an adult ISA once they turn 18. And there's also the lifetime ISA, which is relatively new. It replaced a prior product. This is if you're over 18 but under 40, you add 4K per year, and as part of that, the government gives you a 25% bonus all the way until you're 50. The difference between the lifetime ISA is how you can access it. So you can only access the money if you are buying your first home, age 60 or above, who diagnosed with a terminal illness. I mean, you can access it before that, but then you would pay a 25% penalty to do so. So the lifetime ISA is very useful if you're looking to buy your first home. So when those savings are growing in a tax-free environment and you get the government bonus, maybe you can use it as alongside your pensions, as your retirement planning. Again, you can get that bonus for 10 years. It's effectively a free kind of 10K from the government. Sorry, you can get it for more than 10 years if you start early enough. You can only keep adding until you're 50, but you can access the money when you're 60, and it's a nice little retirement pot that you can kind of build up with that and access it as and when you want when you reach 60. So the other option is a UK bond. So the way a UK bond works is it can be an offshore and onshore bond. We won't go into too much detail about the different requirements of that, but effectively you invest a lump sum into a UK bond, and then it allows you to draw 5% each year, effectively returning the capital for 20 years with no tax liability. So it's a very efficient way of you invest your money in the bond. There's no taxation on that while it's building up, and you can draw that 5% each year, and any growth is deferred until the end of the 20 years or when you want to close up that bond. So it's a more technical product than the ISA. So if you're in a position where you think you may want to take advantage of that, we can have a more in-depth conversation with you regarding that. Because as part of the UK bond as well, you can use something called a discounted gift trust. Now, a discounted gift trust is another way of being able to plan against your inheritance tax liability. So effectively, when you set up the bond, you settle it in the discounted gift trust, and the insurers and the actuaries, they calculate based on your age and your wealth and your life expectancy, how much of that and a portion of the bond can be gifted immediately outside of your estate for UK inheritance tax. So they can work out, say, okay, 30% that's immediately outside of your estate for UK inheritance tax. And then the remainder, because you've been gifting that, as long as the gifting done in the right way, that slowly is removed from your estate over the 7 years. So again, you're using that 7-year rule, but you have the head start of a proportion of that is immediately outside of your estate. So again, a UK bond settled in a discounted gift trust, not suitable for some people, very, very suitable and tax efficient for others. If that's something that you think may work for you, let's have a kind of conversation one-on-one regarding that. Feel free to reach out for us. Now, another question that we have a lot is okay, I'm returning to the UK. I transferred my pension to a QNUPS, which is an offshore pension scheme. What do I do with that? Do I keep it in the QNUPS? Do I transfer it to a UK SIP? Can I do that? What should I do? And there is no right or wrong answer. It depends on your individual circumstances. Once you return to be a UK tax resident, you can transfer that QNUPS to a SIP, but also you can retain it in the QNUPS structure. And really, there's not a huge amount of difference between the two. I think mainly it's assessing the different costs between the two options, the investment options between the two options, how well and how happy you are with the pension trustees who may be managing that. One thing to bear in mind, though, you might have an offshore financial advisor, and if they don't have the relevant permissions in the UK, then they likely can't give you advice on the SIP or the QNUPS, regardless of which product, because advice is dependent on where you are living. So I mentioned at the start of this webinar, we're in a fortunate position that we have the permissions in Europe and in the UK. So there can be a seamless transition, and then we can assess. And it's not a case of you saying, I need to find a new advisor who can manage this for you. I'm operating with my offshore advisor, even though I know he's not regulated, and there are a lot of risk involved with that. You don't have if there's bad advice, you may not be covered. So we can make a seamless move as part of your transition back to the UK. And then the final thing I want to talk about is a QNUPS, which is a qualifying non-UK pension scheme. A QNUPS is a pension scheme, but not that we're generally used to. We're used to a pension where you make contributions for your working life, you receive tax relief, and then you have a part of an annuity at the end of that. A QNUPS is funded via a lump sum, and it's a non-UK pension scheme. So you need to set this up while you're a non-UK tax resident. There are some companies, someone highlighted this to me in a webinar that I ran yesterday, who said, so-and-so company say they can do a QNUPS for me, even though I live in the UK. I mean, that's how they want to operate. We would not do that. And for me, the clue's in the name anyway. We've gone through all the literature. It's a non-UK pension scheme. When it's set up, the fact that you're returning to the UK is not an issue, and you can hold a QNUPS as a UK tax resident, but it needs to be set up when you're outside of the UK. And so why would you use a QNUPS? Well, for one, you invest that money within the QNUPS, then there's no capital gains on the growth without it. Income withdrawals, that depends. You will pay tax on that. It depends on your tax residency. If you're living in Spain, Portugal, Gibraltar is very tax efficient on income withdrawals. If you're living in the UK, effectively it's pension income, so it's added to your income tax liability. So it depends on how much your income you're taking, what other sources of income you have. But a big attraction of the QNUPS is that any sum invested is immediately outside of your estate for the purpose of UK inheritance tax. So we talked about your UK domicile and this large UK inheritance tax rate of 40%. If you invest in a QNUPS, this is outside of your estate for UK inheritance tax purposes, even if you return to the UK. So our advice for people who a QNUPS is suitable for is to set this up as soon as possible while you're an expat. It's very tax efficient for income withdrawals for expats, depending on your country of residency, but in Portugal, Spain, and Gibraltar, yes. There's a webinar that we ran yesterday purely on the QNUPS. If you're interested on that, it'll be added to our YouTube within the next week or so. So where you're an expat, extremely tax efficient on withdrawals, no capital gains on the growth. And if you remain UK domicile, it's outside of your estate. But then you return to the UK anyway, remains outside of your estate for UK inheritance tax because it is a pension. Now, the only caveat with the QNUPS is it must be set up as a genuine retirement vehicle, and the investment has to be in line with your wealth, age, and future income requirements. So to use a practical example, say if we have an individual come to us, say, okay, I'm returning to the UK. I'm age 75. I want to go back to the UK to spend more time with the family. I've got net wealth of 4 million. I know I'm going to have an inheritance tax liability. Let's put 3.5 million in this QNUPS. Well, in that situation, that is an inheritance tax fudge. That's the only reason for setting it up. The amount that's been funded is unreasonable with that individual's age and overall wealth. So HMRC would look through that and say, no, this isn't genuine. We will tax you on that amount. So for the QNUPS, the earlier you plan, the better, because there's more allowance and more you can invest in that. And it has to be set up as a genuine retirement vehicle. So one of the rules is that you have to start taking income by the time you're 75. But it's a very nice way of increasing your retirement provisions. If you don't have a huge amount of pensions, then it's a great way of setting this up with added benefits, but you can take an income in your retirement. If you're in the UK, if you're returning to the UK, or if you're planning to move abroad or you're living on abroad. So if you want to talk about the QNUPS, like everything we talked about today, there's more detail to be discussed. It may not be the right product for you, but we can have a conversation and assess this and all the other different options for you. So that covers a lot of the detail about taxes and opportunities you have returning to the UK. So people often ask us, okay, what are the common mistakes that I can make? So in fact, a lot of these are very similar to those people leaving the UK for shores. Don't hide and not plan, because the taxation in the UK to other countries is completely different, and ignoring the situation is maybe our natural instinct, but it's not the way to go. Make sure that you're taking advantage of all those tax allowances. Make sure that you're taking advantage of the tax planning opportunities. Look at the greater picture. And it's not just a simple case of let's use this product, let's use this product. What are you trying to achieve? Is your aim to protect against an inheritance tax? Is it to protect against capital gains tax? Is it to increase your income? Is it to provide for your family? We all have different financial aims, and it's important to kind of understand. And in line with that, we often get asked, what's one piece of advice you would give to someone returning to the UK? Our answer to that is plan in advance as much as possible. I know these things change very quickly, and we've had clients before, and due to ill health, they've had to return very quickly, and we can help with that. But if you're considering returning to the UK and serious about that, plan in advance, plan before you make that return. The sooner you plan, the better the opportunities that you have, especially while you're a tax resident in a different country. So plan in advance, have a conversation, and avoid the temptation to DIY this. A lot of people nowadays, we go on Google, maybe we're using artificial intelligence kind of prompts these days. There's all these different Facebook groups for people moving here, there, and everywhere, and all those resources have a lot of good information, but also hidden in there, there's some information that is completely false. And sometimes it's a modern equivalent of the man down the pub told me I can do this. You need to make sure that the things are structured properly, and you work with a professional to make sure that that's done properly. Otherwise, you make the wrong move, and there will be financial consequences for that. So it's not a case of scaring people into that, but you need that peace of mind to make sure everything is done properly and structured correctly, and everything is managed properly. For those who are interested, feel free to reach out. It's Fiduciary Wealth Management. You can find our website, fiduciarywealth.gi. If you want to reach out to us directly, inquiries with an E at fwm.gi. And we look forward to talking to you soon. For those watching, please subscribe, like and share our YouTube. We'd be very grateful for that. Thank you for your time today, and have a lovely day.